Index funds are a fantastic way for the beginner to enter into the stock market. By periodically investing into index funds, the average investor is able to outperform those investment professionals. What is going on, guys? It's Thomas here, and today we'll be discussing the benefits of index funds and my top 5 index funds picks which you should have in your investment portfolio. So an index fund is a type of fund which looks to emulate and copy the returns of a particular index in a particular market. They are made up of multiple stocks and bonds and look to copy the returns of a particular index. So an index is an indicator which looks to measure the returns of a particular market. So let's say we're looking at the US market. One of the most common indicators is the Standard & Poor's 500 or the S&P 500, and that's basically the indicator and the index of the top 500 companies within the US market. Index funds are extremely low cost, easy to enter into, extremely liquid and highly diversified. And in my opinion, it's the best way for the average investor to invest their money into the stock market. There are thousands of index funds at your disposal. They cover anything from total market indexes to REITs and real estate investment trusts, and all the way to high growth dividend yielding stocks. It is statistically proven that index funds outperform 80% of those managed funds. And in Warren Buffett's own words, he believes it's the best way for the average investor to invest into the stock market. So index funds are extremely easy to purchase into. They're available in basically any exchange and any platform. So I typically use an Australian company called Stake when I'm looking to purchase my overseas index funds. So Stake is a commission-free platform and brokerage. They have a fantastic platform, a great way to research and analyze different stocks. And at the moment, if you sign up using the link below, you're able to receive a free stock. And for any Australian purchaser, I typically just use CommSec by the Commonwealth Bank, and it's extremely seamless, has a great system and platform available as well, and connects perfectly through with your CommBank accounts too. Now, like I said earlier, the main benefits of purchasing an index fund is diversification. So because you're buying a little bit of all little different companies, you're extremely diversified across multiple market sectors. So basically how these work is that if you buy an index fund like the S&P 500 we discussed earlier, you're basically owning a little bit of all of those 500 companies within the S&P index. And let's say if one of those 500 companies drops out of that index, then the 501st company, which now becomes the 500th company, will be added into the index, and your index fund will be changed and modified as per the new top 500 companies. So not only are they extremely easy to purchase into, they also have extremely low expense ratios. So extremely low cost, extremely easy to purchase, and they're also extremely liquid. So that means if you do need to sell them for whatever reason, they are really easy to sell, basically just as a click of a button. On the other hand, if you are looking for massive returns, then index funds typically don't receive the highest and the greatest returns. And this is because they are extremely diversified. So because they've got such a wide range of companies within the index, not all companies will be performing at the same rate at the same time, and therefore the returns are capped to a certain percentage. However, on the other hand, if there is a market shift to the negative, like we have seen earlier in the year, then the returns of the indexes aren't affected as heavily if your investors just into growth funds or just into tech stocks. So due to the fact that they are diversified, the returns aren't going to be as high, but the drops and the drawdowns aren't going to be as strong as well. And this is why they are a great option for first time and beginner investors. And this is due to the fact that they are very smooth. The prices don't fluctuate as heavily over time. But at the end of the day, the stock market over the last 50 years has returned 8% year on year. And this is a fantastic return on your money. So it's nothing to dwell on. It still is a huge return and a fantastic way to invest your money. And for the beginner, it's just an easy way just to click a button and buy an index fund rather than doing all this research into different stocks and gambling on different stocks. It's extremely diversified, easy to enter into, and you have the benefit of owning a little bit of the top 500 companies or the top companies within your economy. However, for the more educated investor, I still would recommend to have some sort of index fund within your investment portfolio. You typically want between 70 and 80% of your investment portfolio to be more stable, more high to medium market cap stocks. And then 20 to 30% of your portfolio can be a bit more speculative. So looking at different tech stocks and stocks with potential for high growth. You don't want to be spending all your money on high growth stocks. You want to make sure that you are diversified and you do have that base which you can sit on. And an index fund is a fantastic base for your investment portfolio. And I highly recommend to have some sort of index fund and some sort of diversification within your investment portfolio. And before we get stuck in, if this is something that interests yourself, please make sure you turn that like button blue. Alrighty guys, so now we'll cover my top 5 index funds to purchase for 2020. And number 1, you've probably already heard, I've mentioned it multiple times during this video already, and that's the Vanguard S&P 500 index. So its short code is VOO, and it basically is a copy of the top 500 companies within the US. So this index in particular has shown a return of over 14% since inception, and that's taken into consideration the current market periods. We've still seen double-digit returns since its inception back in 2010. On top of this, it only has an expense ratio of 0.03%, so it's extremely low cost, extremely great returns, and still returns a respectable dividend yield as well. So the next one which I recommend is the Vanguard Australian Exchange Traded Fund, which is the VAS as its short code. And this is a copy of the top 300 companies within the Australian economy. So the VAS doesn't have as great of a return as what the S&P 500 index does. However, it has a dividend yield of over 4%. So it's a great dividend yield and you're still receiving a return of over 8% since its inception 15 years ago. So the next one I recommend is the Vanguard Total Market Index. So the VXUS, and this is basically an index which covers the top companies across the entire globe. So it's looking at those ones away from your typical US and Australian indexes. So you're investing into companies like Alibaba, companies like Samsung and Toyota, and you're able to reap the rewards and benefits of those companies outside of your typical stable economies. So for those looking to invest into high growth funds and you're looking to invest that 20 to 30% like I said earlier, there are still index funds which are available which just focus on high growth stocks. And one example is the Russell 1000 Growth Exchange Traded Fund. So the IWF is a fund which purely focuses on potential high growth stocks, and over the last year it's returned over 30%. So these are your stocks like your Teslas, like your Apples, like your Netflix, your high growth stocks with potential high ceilings. And this index just focuses on these high growth stocks. And the last one which I would recommend is the iShares REIT Exchange Traded Fund. And this is basically a real estate investment trust. Now, a real estate investment trust allows you to buy into an investment company for property. So this index basically just focuses on property investments. It allows you to buy into a property investment firm. And this way you're able to not only diversify your portfolio along equities, but you're also able to invest in the property market as well. Now, the benefit of REITs is the fact that they typically have a greater dividend yield due to the rental yield of those properties within the portfolio, and they have a low starting cost as well. So if you're looking to buy property but you don't have enough to save up for a deposit, REITs are a fantastic way to invest into the property market. So index funds are a fantastic way for the average investor to invest into the property market. They are extremely low cost and generate sustainable returns for your investment portfolio moving forward. The best way of taking advantage of index funds is through dollar cost averaging. Now, dollar cost averaging basically means you invest a little bit into your portfolio every month. So set a goal of a certain amount of money you want to invest in every month, and that way you're able to buy the index funds at different prices. So you can buy it at the highs, and it also allows you to buy it on the way down as well. So I personally invest a little bit every month into index funds. This is the best way to increase my property portfolio and to capitalize on price fluctuations of the indexes themselves. And this is what Warren Buffett was talking about earlier. If you're able to invest periodically and set a goal of a particular day of every month or every 3 months, which you'll be looking to invest, you're able to emulate those returns of the professional investors. So that's it, guys. There's my top 5 picks for index funds to invest in 2020. If you have any yourself which you recommend, please feel free to leave comments below. Otherwise, thank you so much for tuning in. If you did enjoy the video, please feel free to subscribe and click the notifications bell, and make sure you destroy the like button as well. Thanks again, guys. I really look forward to seeing you next time.